people are not spending money on long-term, durable goods. If you look at employment, yes, the new jobs creation is good, it beat the estimate. The unemployment rate is low and static, it's not moving up. But look underneath that and you see that the ADP, which is the private sector company that does job estimates, has a number wildly different from the government number, much lower. And I'm not suggesting that the government is fiddling the numbers, but there's something wrong with the methodology.
Hello everyone and welcome to another edition of Triangle Investor Interviews. I'm your host Lucian Valkovic, and before I announce my guest, just a reminder of a disclaimer. This interview and all my interviews are not a recommendation to buy, sell any shares, products or services. Always do your due diligence and consult with your financial advisor. And my guest today is Mr. Adrian Day, a well-known investment advisor and money manager with expertise in global markets, precious metals, resource stock, and much more. Adrian, always great to have you. Welcome back.
Well, thank you so much for having me back. I really enjoyed our last interview. I'm looking forward to this.
Same here. Let's start with the big picture. Where do you see the global economy heading in the next 12 to 18 months? Are we on track for a soft landing, a recession, or something else? And what key indicators are shaping your view?
Yeah, well, of course, an awful lot has happened this year. We talked at the end of last year. And I think the truth is there's an awful lot of uncertainty in the market right now, an awful lot of uncertainty in the outlook. And uncertainty leads to volatility. My own sense would be that the US economy in particular, but also to a large extent the global economy, is slowing. If you look at the US, I don't want to go too much into detail at the moment, but if you look at the US, there's clear signs that things are slowing. They're not dramatically slowing perhaps, but the trend is fairly clear. Certainly if you look at things like, and the headlines don't really reflect that. So you look at the headlines that show retail sales are strong, but on the other side you see credit card debt at 20-year highs and credit card defaults now at very high levels. So I mean, if people are buying on credit and then they're maxed out on credit, it seems to me that can't continue. And if you look at the patterns of spending, you also see middle income and higher middle income people, in fact, shopping at Walmart, which suggests some stress. You see things like durable sales down. So it's very selective what things are doing well and what things aren't. Obviously, people are continuing to spend money on food because they have to. They're continuing to spend money on shelter because they have to. We've been lucky that the oil prices stayed, low, and so gasoline prices or petrol prices, depending on which part of the world you're in, are subdued, and so that's helped an awful lot. But people are not spending money on long-term, durable goods. If you look at employment, yes, the new jobs creation is good. It beat the estimate. The unemployment rate is low and static. It's not moving up. But look underneath that and you see that the ADP, which is the private sector company that does job estimates, has a number wildly different from the government number, much lower. And I'm not suggesting that the government is fiddling the numbers, but there's something wrong with the methodology. And certainly there's no dispute among anyone that the BLS, Bureau of Labor Statistics numbers, are much, much higher than the ADP numbers. So something somewhere is not gelling. Anyway, enough on that. I mean, I think the economy is sort of slowing. China's economy also seems to be slowing. And so if you have a slowing economy in the US and in China, then that seems to me that, that's serious for the whole world. And all of this was happening before Trump came into office. So I'm not trying to make any kind of, I'll try not to make political statements, but I think it's true to say that a lot of the Trump policies, particularly on tariffs and the putting them on, taking them off, putting them on, that has added to a lot of uncertainty. And so what it's also done is made some of the statistics not really a good reflection of a medium or longer term trend. So if importers thought that very high tariffs were coming 4 weeks from now, or 4 weeks from a particular date, then the natural reaction was to import more. And so we saw import numbers kind of distorted because of, importers just buying more ahead of tariffs. And then the tariffs didn't come, and they had to supply, so then you saw import numbers go down. So some of the statistics are not really giving very good indications, in my view. But on balance, of course, tariffs from an economic point of view, on balance, are not a positive thing. And they're not necessarily inflationary. A lot of people seem to, even Jerome Powell, inflation's all under control, except we don't know what the impact of tariffs will be, and it might be one-off or it might be more permanent. But tariffs, when you increase prices of goods, you actually make people buy fewer of them. And so, if anything, that's recessionary, not inflationary.
Yeah, you mentioned inflation. With the Fed balancing inflation and growth, what do you expect from their interest rate decisions and monetary policy through the remainder of 2025, and how should investors position themselves for these shifts?
Right. Well, there's very little doubt in my mind that by the end of the year we will have seen a rate cut. And the Fed itself, in their dot plot, is calling for two and a half rate cuts on average, 2.5 rate cuts this year. What's clear is that Powell himself, Jerome Powell, the Fed chair, is reluctant to lower rates at this point, I think, for two reasons. One is he does seem genuinely concerned about the uncertainty around inflation. He thinks the job market is very strong. I think he's mistaken there, but he thinks the job market is very strong, and certainly the backward-looking statistics might tell you that. And so he doesn't see the need to lower rates, and at the same time he's concerned about inflation ticking up, and so he's reluctant to cut rates. I think the other thing, frankly, is he's a human being. He doesn't like Trump to tell him what to do. And so, frankly, if Trump really wants rates to be cut soon, how can I put this nicely? He should just keep his mouth shut. And I think we'd get to that point sooner. I think my own feeling is that more important this year, more important than rate cuts, might be another QE, quantitative easing. As you know, the Fed has been on QT, quantitative tightening, for a while, but that program is really slowing down dramatically. In January it was $35 billion a month, and then in maybe April we went to $25 billion a month, and last month we went to $5 billion a month. $5 billion a month in a almost 7 trillion balance sheet is sort of irrelevant. And of course they're not actually selling anything, they're only letting some of it roll off, but $5 billion a month. So in my view, QT has essentially, effectively finished. Now, if we get to the end of summer or the end of August, let's say, the debt ceiling in the US is raised, and the Treasury has to issue, X amount of bonds, 700 billion, but in a shorter period of time. That's 600 billion more than they did last year. And if instead of having the whole year to do that, the fiscal year ends at the end of September. So if we don't raise the debt ceiling until August, there's only 2 months, 1.5 months left to issue that amount of money. So the supply is going to go up dramatically over a given period of time. And of course, we all know that the buyers, the traditional buyers, Japan and China specifically, are buying fewer. In fact, they're selling, net sellers, not dramatic sellers, but net sellers. Regional banks in the US are not buying because of that whole mark-to-market issue, which caused Signature Bank and Silicon Valley Bank and others to go bankrupt 2 years ago. Was it? Yeah, 2 years ago. And so we're not seeing so much demand from that sector. The Social Security, which is a large holder, Social Security Trust Fund, which is a large holder of treasuries, they don't have the cash to buy at the moment. Anyway, we could go through all of the big buyers, and you find that not only are we getting more supply in a short period of time, but traditional buyers are not there. So who's going to buy the bonds? Now, at the short end, if they issue anything under 2 years, I think there's a large demand for that, depending on the interest rate, of course, but at 4.5%, there are many other places to put your money safely and get more than 4.5%. So I think there's demand at the short end, but there's very, very little demand at the long end. And I suspect that the Federal Reserve is going to sort of ride to the rescue with QE and start buying more bonds.
Yeah, whether we will have rate cuts, pauses, or QT, how will this affect key asset classes like equities, bonds, gold, and what risks should investors watch to?
Yeah, well, I think both of them, I mean, they both have different sort of characteristics. Of course, lowering interest rates is designed to help the economy. QE is designed to help the government. But generally speaking, I think they would probably be positive for the stock market, both of them. They would be negative for the dollar because it would make US assets less attractive. But it would be wildly bullish for commodities and particularly for gold. We saw this last time they started QE, wildly bullish for gold, in my opinion.
Yeah. Adrian, there's been a talk of central banks, including the Fed, showing signs of panic in response to volatile economic data. Do you see the evidence of that?
Central banks panicking? No, I'm not sure I do, to be honest. I'm not sure that most central banks' policies are the right ones. Japan is obviously the poster child for how to do it wrong. No, I mean, we could criticize the Bank of England, we could criticize Swiss National Bank, frankly, which was the biggest surprise of all, and certainly criticize the Fed. But I don't think they're panicking, no. I don't see that at the moment.
Sure. How do you see investor sentiment? Investor sentiment seems to swing between fear and exuberance. How are you reading the current mood among institutional and retail investors?
Well, that's a good question because, as you probably know, increasingly over the last sort of 6-8 months, increasingly we've seen institutions and particularly, I'm talking the stock market now, institutions and insiders reduce their purchasing, whereas retail continues to buy. So it looks to me in many ways that we're getting a classic distribution in the stock market. Obviously, insiders will always tend to do more selling than buying because they get cheap shares, they get free options, and blah blah blah. So there's always a bias on the side of insiders to sell rather than buy. But what we've seen this year is the ratio of buying to selling declined dramatically. So it's like 20 to 1 now. And of course, when an insider buys stock in the market, that is without question a bullish, it's a reflection of a bullish sentiment. They can be wrong, of course, but it's a reflection of a bullish sentiment. And selling, you have to sort of, as I say, you have to make adjustments for that. Are they just selling some to pay taxes on, you know, exercising options or whatever? But retail, the sentiment has swung dramatically. We've had in the last 3 months, 4 months, we've had virtually new lows in the one I follow is the American Association of Individual Investors Bull Bear Sentiment, which is just a survey. It's not what they're doing. It's how do you feel about it? But we've swung from record lows, virtually record lows, to very close to record highs and back again. So the sentiment among individuals has been swinging depending on the news, and of course the news has been very volatile. But what you are seeing, of course, is most money in the US is in 401k plans. And 401k plans, as long as you still have a job, right, that just comes every month. You put X amount in, your employer puts Y amount in, often they match, sometimes they more than match. But, and that money just keeps pouring into the stock market. And I've said this before, you know, some of my clients will send me, typically once a year, sometimes at bigger firms it might be once every 6 months, the plan administrator will send the participants a schedule. Where do you want to invest your money for the year ahead? And unless you're at a very big firm, it's US growth, US big cap, US value, probably a global fund, no emerging market funds, no emerging market bond funds, no gold funds, you know. And so I say, and cash, of course. So I say to people, well, in that sort of scenario, I always say go for the global fund, but I'm sure most people just go with the S&P fund. And so that money just keeps pouring in and pouring into the S&P. It's just on automatic pilot at the moment until the economy slows and people start losing their jobs.
Yeah, you got that right. Adrian, given the Fed's influence in shifting investor sentiment, what's your outlook for gold and silver prices over the next 12 to 18 months?
Well, I mean, obviously for the last year I've been saying we're overdue for a correction, And as of this morning, I'll say maybe we'll get a correction soon. But what is astonishing to me is the resilience you've seen in the gold price. Every pullback of any size has been halted very, very quickly by new buying. Gold has been remarkably resilient. And that's without Western, well, not so much Western, because European ETF flows are reasonably positive. But that's without the US and North American investors really participating at all. And so, and lots of indicators tell us that. I mean, you look at flows into GLD, you look at flows certainly into the gold stocks, are very, very negative. Coin dealer friends of mine tell me that they're very, very busy, but over half the calls are people wanting to sell, not wanting to buy. So anyway, so gold has been remarkably resilient, and that's based on central bank buying, based on Chinese non-official buying. That's a large portion of the gold purchasing, and based on wealthy individuals, wealthy families in the Middle East and Asia and Europe who are just concerned about the fiscal situation and want protection. And that's without the US investor coming into the market. So I think as the economy changes, The US investor typically buys gold based on the economy and economic factors. And what we've seen for the last couple of years, a strong economy, low and declining inflation, high interest rates, relatively strong dollar, that's precisely the wrong environment to be buying gold. As that shifts, and we're seeing it shift now with the economy, also with the dollar, as that starts to shift, you're beginning to see signs of US investors moving into gold. As that picks up, I think the demand for gold is going to be very strong. And whether the Fed cuts rates twice this year, whether we have QE or not, we're going to get something from the Fed on the easing side. They're not going to be tightening by the end of the year, they're going to be easing. And that's going to be very, very bullish for gold.
Yeah, so you would say that the retail actually didn't enter the gold bull market yet.
Yeah, absolutely. And that's particularly true when you can see that with the stocks, because of course, the Central Bank of Kazakhstan or whatever doesn't buy Newmont Mining. Sorry, I pronounced that wrong. Sorry,
Okay.
But you know what I'm saying.
Yeah.
The Central Bank of Uzbekistan doesn't. I mixed up two countries. Doesn't buy Newmont Mining. Mr. Wong in Beijing doesn't buy Newmont Mining, right? It's North Americans who buy North American gold stocks typically, with some help from Europeans. You look at the GDX, which is the largest gold mining ETF in the US, and it's had about 407, almost 500 million of outflows in the last month. In the last month, it's had 3.2 billion of outflows this year. So you see in February you saw a few days of inflows, and then in May you saw a few days of inflows, but we're back to outflows again. So the sentiment is certainly not, we can say they're certainly not pouring money into gold stocks.
Sure.
Yeah, but I think that's going to change. It's going to change as the economy changes.
Definitely. What about silver, Adrian? Silver finally broke this 35 level. Are the glory days of silver finally coming? Is the manipulation over, or is the manipulation fairy tale? There is no manipulation. What's your take?
Well, first of all, on manipulation, I tend not to worry too much about that, because if something's happening that's out of my control, well, there's nothing I can do about it. I think there's very little question that there has been manipulation in the gold market, very little doubt. I mean, big banks have been fined for manipulating the gold market, the silver market. But eventually I think the market wins out. I mean, eventually the market wins out. People who I don't think there's a grand manipulation scheme among all the central banks and the big money center banks and the Vatican and the royal family to control the price of gold and the price of silver. I don't believe that. I believe people are just, manipulating the market in their own interests, just as, frankly, people manipulate the stock market in their own interest by, heavy buying in the last 30 minutes of a quarter. I mean, that's been going on for years. It's nothing new. So silver, I think we've seen we've clearly seen a breakout, and I think we've got a new floor now. $30 looks like the new floor, and maybe even 33, but $30 looks, I mean, there is some good support on the chart at 33. So certainly I think we've found a new floor, we're in a new level. I'm not sure, to be honest. I'm a little skeptical, but kind of this is it. But silver's going to go to $50 or $100, in the next month or two. But as you know, silver does have these very, very, dramatic moves in very short periods of time, up and down. Yeah.
Yeah, when it goes really, really, really fast. Agreed on that. Adrian, let's talk a bit about resource opportunities. With your expertise in resource equities, which subsectors, mining, energy, or commodities, looks the most promising for investment today?
Yeah, no, good question. And as you know, I should start by saying that commodities are virtually at a 100-year low relative to commodity prices relative to financial assets. And specifically, commodity equities are indeed at 100-year lows relative to the broad stock market. I just want to make sure people understand that. We're saying they are at 100-year lows, literally. And, you know, they're at meaningful lows, not just marginal lows. So there's no question in my mind that the commodity sector is an extraordinary contrarian opportunity right now. You know, if you look at the subsectors, oil has its own dynamics, of course. Well, they all have their own dynamics, but oil can move contrary to the rest of the complex. Agriculturals can move differently than the metals. What I'm focusing most on at the moment are the commodities where there are supply shortages or potential supply shortages in addition to demand growth. Now, obviously, the price is always a combination of supply, demand, and stockpiles. I mean, obviously. But sometimes the demand picture or the demand narrative is demand is driving the narrative. Sometimes supply is driving the narrative. And I'm more focused at the moment on things where supply is an issue. And that would be primarily copper and uranium, in my view. Both of those, if you look out 5 or 10 years, both of those have a potential to have meaningful supply shortages. And supply shortages, of course, doesn't mean we're going to run out of copper one day. It means the price is going to go up, obviously. I mean, you know that, but
Yeah.
but we talk about shortages. Now, I much prefer gold over the other metals, certainly in the near term, because if we have a global slowdown, economic slowdown, doesn't have to be a depression or anything, just a global slowdown, that hurts the demand for most of the commodities, particularly if China's economy slows, because China is still the number one importer and consumer of most commodities, and that includes uranium and copper that I just mentioned. So I think there's very, very powerful supply-demand dynamics for both of those two, but a slowing economy would maybe depress or suppress any upward move.
Excellent take. Adrian, how can investors reach out to you?
Well, the best place would be adrianday.com, which is easy.
Leave the link in the description of this video. As always, great chat. I really thank you very much for this great talk, and I look forward to host you again sometime soon.
Well, thank you so much. I appreciate it.